about what the midterms could mean for investors. So we're talking politics, but we're really talking about what this means for investors. We can't handicap the elections too much, although we can look at some recent polls, but we're going to get right into it. We have Preston Caldwell, the head of U.S. economics for Morningstar, Dave Sekera, the chief U.S. market strategy at Morningstar, and Anastasia Amoroso joins us again. She is the chief investment strategist at iCapital. So let's just dive right in because I think this is a big topic on a lot of investors' minds right now. Even though, elections are not typically a great place or a time to do investing handicapping, we have some historical data to look at. But we also know going into this that midterm election years, especially going into the quarter of a midterm election, are terrible times to invest. September is a terrible month, especially in a midterm election year. There's lots of stats on that out there. But just looking at the poll of polls, and I'm just going to set the stage here. I was just looking at a poll of polls on 538. Do voters want Republicans or Democrats in Congress? 44.9% want according to Democrats, 43.5% want Republicans. That's a pretty even split, which kind of forecasts a little bit what we might be facing come November. Things may just stay the same, and we may just have this gridlock going forward. So looking at that, looking at what may happen, how do typically midterm elections or elections in general, Anastasia, I'll start with you, impact the market, if at all?
Yeah, well, Caleb, you alluded to the fact that leading into a typical midterm election, stocks don't really do much, right? There's a lot of policy uncertainty, headwinds that kind of build, and kind of the initial, any sort of stimulus or initial policies of the first 2 years, they sort of fade, and so stocks kind of struggle a little bit heading into the midterm election. But typically after that, stocks do rebound, and maybe one might expect the same, sort of setup this year, but I probably wouldn't hold my breath for that just yet, because the reason why stocks likely rebound after the midterm elections, maybe you have some sort of a significant policy push to make the election outcome more favorable for the party that's in control. But I don't know what exactly can be done about the issue du jour, which is inflation. I don't know what we can do between now and November that would bring inflation significantly down. So I don't know if we're going to get that particular boost. I think in order for us to have a similar experience where stocks rally after the midterm elections, that to me would have to coincide with inflation starting to come down and the Fed finally starting to ease up. So to the extent that it does, I think we could see stocks rally. But again, it's not because of the midterms or any sort of policies. The other thing I would say, the most likely outcome based on some of the predicted data and some of the polls that we see will likely end up with a split government, Democratic president and split Congress. And if we look at all the configurations and permutations of who's in Congress, who is in the White House, that combination actually tends to be one of the most supportive ones for stocks. So perhaps we do have history on our side there. And finally, one other silver lining that I see from the midterm election, if we do have gridlock in Congress, then most likely no other fiscal policy pushes will get done. I think that might be good for inflation. I have a friend of mine who is a professor at Johns Hopkins who authored a paper that was unveiled at Jackson Hole, and they sort of proved academically that a lot of what's causing today's inflation is the fiscal push that's been added to the economy. So to the extent that we don't add to it, maybe we'll actually help the Fed do its job.
Yeah, we may be done with the government spending after the Inflation Reduction Act, which is inflation reducing in name only, is passed, and we get some of that spending out there. But Preston, let me get to you real quick. Is it going to be monetary policy, or is it going to be legislative policy that matters most going over the next few months?
Yeah, and I want to preface that first with, especially with our Morningstar's investment philosophy, which is very long-term focused, that, in that vantage point, the public and media really overrates the importance of politics for investors and the economy. And that's for several reasons. I think we overrate within the space of possibilities how far apart the policy positions really are between the two parties. And, from any objective measure, not that much changes from election to election. And to directly answer your question, so in ordinary times, fiscal policy really doesn't matter that much because, the conventional theory is that it's whatever happens to fiscal policy, it's offset by the Fed. Now, last year we had unprecedented fiscal stimulus in size based off of the macroeconomic environment. And we also had, for arcane reasons, the Fed not responding to that fiscal policy as it might ordinarily would. But ordinarily, if you have spending jump up or the deficit jump up by a percentage point of GDP or something like that, that's something that's going to be offset by the Fed and will effectively sterilize that fiscal policy change. So monetary policy is in the driver's seat and will remain more important, the most important thing, because the Fed is going to adjust interest rates up and down to try to calibrate the economy with where its productive potential is, because it doesn't want to let things continue to overheat and generate the inflation that we've seen. Although I think there are other factors, in my view, besides fiscal policy that have generated the high inflation we're seeing right now. But maybe one or two caveats. I will say that if we were to get in a much more adverse economic scenario, which can happen, where we did need fiscal stimulus, which is hard to imagine right now. But if we were in a situation like in the early 2010s when we were at the zero lower bound, where interest rates were at zero, and so they could do very little additionally in terms of monetary policy, and we needed more fiscal stimulus in that era, we couldn't because of political constraints, which we could return to if the Republicans take back control of the House as well as the Senate. Maybe that won't happen, maybe it won't, but that would be the only scenario, particularly if there was a impasse over raising the debt limit that required a large fiscal consolidation like occurred about 10 years ago.
Mm-hmm. Right. We're not going to get new taxes. It looks like the opportunity for that came and went with the IRA. That never happened. So what do you think, Dave, is going to be the most important catalyst for investors, whether it's election related or not, as we look out the next 3 to 5 months?
I don't think that the election in and of itself is really that big of a catalyst, for investors today, especially long-term investors. You were mentioning earlier about kind of some of the historical precedent of what's happened in like the second quarter and the third quarter beforehand. But I think you also have to look at some of those instances in the past that, it was more maybe a trading opportunity, but there were a lot of other exogenous variables that were going on in the markets and the economy at that point in time that I think were much more important than the midterm elections. So coming into this year, we noted that there were going to be 4 main headwinds that the market was going to have to contend with this year. So again, we were looking at inflation was running hot. We expected interest rates to rise. We knew that monetary policy was going to tighten. So when we started looking at all of those headwinds, we thought the market was overvalued coming into the year. That really was kind of the environment that we were. Now, at this point, we think that most of those headwinds now are starting to abate. They haven't turned into tailwinds yet. Now, we do have some new headwinds coming in. We do see that we're at the precipice of a recession, over in Europe. We do have the strengthening of the U.S. dollar. That's going to be another headwind, for earnings for the next couple of quarters. And I think that there's going to be a lot more volatility, same that we've seen over the past couple months, going over into the rest of the year. So while we think that the markets right now, based on our intrinsic valuations of the about 700 companies we cover, we think the market is actually pretty undervalued at this point. But the market could stay undervalued for a while before we start to see, really that tailwind start moving the market forward over the next, 2023 or so. Yeah.
Presidents like to take credit for rising stock markets and take no blame when they fall, and really they don't have a lot to do with it unless they are passing big tax, increases or decreases or affecting legislative or fiscal policy in that regard. But we still have situations like we have tariffs with China. We have some uncertainty outside the U.S. That could affect U.S. investors and investing in the U.S. Is there anything on the outside of what may be happening in Europe with an energy crisis that could have an impact that could be tilted one way or by what happens in November or not?
Yeah, there's always something that can happen. And again, I'm not a political analyst and I'm not trying to game, this system here. And as long-term investors, we're really trying to understand, what is the intrinsic value of this company's coverage, that we have. And again, we do take a different approach in looking at market valuation that, I take this bottom-up approach. And so we look at, for every single company we cover, where is it trading in the market and what's our valuation? And we put together a composite of that. So even like based on today's market action, we think that the markets are probably trading at about a 17 to 18% discount to those composite of fair values. that puts us in pretty rare territory. We've only seen, these kind of discounts, several times, since 2010. And those were occurrences when we had, the beginning of the pandemic in March 2020. Otherwise, you have to go back to like 2011, during the pigs crisis, Portugal, Italy, Greece, Spain, when everyone was worried about, the banking crisis, in Europe at that point in time. So we really see a lot of value for long-term investors today. I think that investors today are just going to have the intestinal fortitude to be able to live through, these next couple of months with, heightened volatility.
Yeah, tough when our animal spirits are telling us to run and hide. But to your point from earlier, Anastasia, this is the time to be bold, and this is when the bold get rewarded by going, into markets that don't look so, where the visibility is not that great. You wrote recently about the Inflation Reduction Act, Anastasia, in one of your notes, and how that could be a big boom for green energy companies, renewable energy companies. We saw some big moves in that regard over the last few weeks after this was passed. Some of that's faded with the rest of the market, but does that still have some sort of tailwind behind it as we look out a couple of years, or is that really when the spending kicks in and that's when those companies should benefit from it?
Oh, I absolutely think there's more runway to the clean energy story. And, if you ask me kind of right as the Inflation Reduction Act, or should I say the Climate Act got passed, I would have said, okay, now may not be the time to tactically buy into these clean energy equities because they have rallied a lot over a very short period of time. But the reality is the provisions of this Climate Act are really long-term in nature, and they provide a lot of certainty and a lot of incentives to the clean energy industry. I mean, for example, the fact that the production tax credit, the investment tax credit for wind and solar, well, first of all, it also applies to other parts of the industry now. The fact that that got extended significantly, by many years versus expiring this year or maybe next year, that gives a lot more visibility to some of the clean energy companies. So, as you know, companies are more likely to commit investment capital if they know what the operating environment is going to be. The fact that there is support to the electric vehicle industry, I mean, let's face it, it's not tremendous. It's $7,500, in tax credits. And by the way, the cars have to be mostly assembled in the US. That's going to be a challenge given that, half, if not more, of the electric vehicle supply chain is, in China and parts of Asia. So it's going to be a challenge, but nevertheless, it really kind of provides the long-term support that the industry needs. But even the government aside, I mean, if you look at the transition that needs to happen over the coming decade or decades, right? I call it the decade of sustainability. In order for us to get to some of the net zero goals, the estimates out there, we need to invest between 100 to 150 trillion, depending on what flavor of green scenario you're going for. That's a lot of trillions of dollars that need to be invested across the ecosystem. So for that reason, is it all priced in? No, absolutely not. Maybe the initial policy support is, but as these companies, benefit from, for example, more residential solar, the revenues will grow, the earnings will grow, and maybe some of that will grow into their valuations. So the last thing to sum it up, if you look at the S&P 500, over the next 2 years, we're expecting earnings growth of about 9% on average, probably best case scenario, right? If you look at the clean energy companies, we're expecting earnings growth of 22% per year. So even if they're trading slightly expensive to the S&P, once you adjust that for that earnings growth and years to come of this secular transition, I think, we're definitely not priced in enough. But sorry, the last thing I'll say about this, because we were talking about kind of what issues might come up depending on whether we get gridlock or, maybe we have more Republican representation in Congress or Democrat. I think if we do manage to keep the current, form of the government, which is not likely, but let's say it's, a Democratic sweep, you will continue to likely see very supportive policy and regulation and nominations that would promote the clean energy industry. On the flip side, whether you have a split Congress or if the Republicans manage to take both sides of it, then I think you will see more supportive oil and gas policies. So you could see a little bit of trading opportunities and divergences around that. And then, Preston, one of the other issues that you mentioned was the debt ceiling, and that we're going to bump into at some point in the first half of the year. If it's gridlock, then I could see us having, a mini 2011 type of a scenario. If it's one party or the other that controls it, it's probably a little bit more smooth sailing.
Yeah, great point. Let's get back to monetary policy for a second. Obviously, Fed meeting on interest rates this week. We expect a rise. Nobody's going to be surprised by that. Maybe by the size of it, we might be surprised by it. But Preston, you wrote back in August, you expect the Fed to start cutting rates next year in 2023. You still holding that belief? And does a lot of it depend on what happens with the inflation numbers going out into October, November, and December?
Well, yeah, I do hold to that, and it doesn't depend entirely on inflation, although not necessarily just the next few months, but obviously going into 2023. If we do make progress on bringing inflation down like I expect, then it's going to be a process spread over the next year, and it's going to be probably a bumpy ride because the inflation numbers are volatile from month to month. So, I don't expect any big news over the next couple months. But we are seeing very clear signs that supply chain issues are resolving. So, it's hard to predict when, but eventually that's going to deliver major relief from inflation, if not outright deflation within certain industries. We're already seeing this to some extent with energy prices having come dramatically off their peak. We haven't seen any of that relief in, say, autos or other durable goods where the supply chain issues have driven up prices dramatically compared to the pre-pandemic trend. So once that starts to happen, and again, I think it's a question of when, not if, we will see major relief from high inflation, and that will be the green light for the Fed to start cutting rates because the Fed has a dual mandate. They want to keep inflation low and stable, but they also want to prop up economic activity. So with inflation being taken care of, it'll switch. The Fed's priority will switch the other part of their mandate of propping up growth, and that will be needed next year to avert a larger economic slowdown, especially given how monetary policy transmits through the housing markets and the size of the housing downturn that is coming into place right now.
Right. How important then do you think, and I'll start with you, Dave, and again, we're not political strategists or prognosticators here, but how big are the CPI prints going to be for the month of September, for the month of October, as folks go to the polls? Because we know that the economy is the number one issue on voters' minds right now, far and above just about everything else. Actually, far and above everything else, but about 80% of respondents cite the economy as their number one concern. How big do you think those will be as we head towards November?
Well, I think that goes back exactly to what Preston was saying, is that as those numbers come out, it's really much more important from a monetary policy perspective and how that will then transmit into the Fed's interest rate paradigm going forward over the next couple of months. So again, from a political point of view, if the numbers are high, then of course, yes, the Republicans will use those numbers in order to try and batter the Democrats. If those numbers are coming down, then the Democrats, of course, can go out and talk about that, yes, we have inflation under control. So again, I think it will matter much more in the headlines than it will necessarily impact, the economy in the short term.
Yeah, and investors, we're blinded by headlines constantly. If we decide to pay attention, we'll get more than enough of them. But as folks approach an event like an election, typically not a big investing move one way or the other. I remember when Trump was going to be elected, everybody thought the market would tank. The market went off and ripped, much higher.
Well, you have to remember too, oftentimes the market's first reaction is wrong.
Absolutely.
I can't tell you how many. Exactly. So when Trump was elected, I think the market initially took a big, huge hit in the overnight trading markets before they started moving back up. I can't tell you any time, over my career, how many times I've seen, some economic metric or some number come out. The market immediately moves, one direction until people actually kind of really think about it, and then all of a sudden you see it reverse course.
It happened last week. It'll probably happen tomorrow. It'll happen.
And again,
on
as long-term investors, you really need to keep the bigger picture in mind and really think about intrinsic valuation of the companies and thinking about, we're not pricing just what the PE of this company is, based on this quarter's numbers. How much free cash flow can this company generate over the course of its lifetime? And what is the appropriate discount rate in order to be able to come up with that fair value today?
Yeah.
Caleb, can I pick up on the inflation issue just for a minute, and like what can potentially change on the inflation front as we head into the election? I mean, the month-over-month, the year-over-year numbers are probably not going to change drastically. But to your point, consumers pay attention to headline inflation. We pay attention to the core, and the Fed is really focused on the core. But if you look at consumer expectations for inflation out of the University of Michigan, on a one-year basis, they seem to have peaked and they started to trend down. And there is a very direct correlation of what's been happening with gasoline prices and oil prices. And as consumers have seen the price of, their tank of gas go down at the pump, they have repriced those expectations lower. So perhaps that's one thing that is kind of changing on the inflation front. And maybe that does make the narrative just a little bit more supportive for the Democrats going to the midterms.
Right. Gas prices, what you see at the corner when you're passing gas stations is probably one of the most important signals for inflation for consumers straight up. I mean, that is for them, even though we have high food prices, even though we have high electricity prices. But going back to some of the good news on what happens after the election, if you look at history, no matter who or no matter what, the S&P 500 gained a year after the election every single time since World War II with a solid 14.1% average gain over the prior year. Why has that happened? Maybe a little bit of relief.
Well, again, you also need to be careful. You're using these, historical comparisons going back to World War II. And if you look at what the markets did, back in the 60s and 70s, there you saw the big double-digit decreases in the market in Q2 and Q3 going into those midterms. So you already had a huge market downturn. I would suffice to say that I think we're in a very different environment today than we were back in the 60s and early 70s. So I really don't like using the historical precedent because, again, I think that gets investors thinking too much about trading, especially trading on something that's going to be a much different environment than what we're in today.
Yeah.
I think you need to have those long-term perspectives and goals and not really get too caught up in any one individual market movement quarter to quarter.
Right, but there's a seasonality. Typically, one of the worst quarters. This is typically a pretty weak quarter sometimes, especially in the midterm election year. But to your point, if you get caught up in that and you think it's going to be like it was 10 years ago, 20, 40 years ago, that's a great way to miss out on opportunities or make a big mistake.
And I think David is right to point out that we shouldn't extrapolate causality here. Just because we have the midterms, the stock market is going to rally just because the historical precedent suggests this. But there could be an interesting coincidence around this midterm election. It is possible that perhaps in the next couple of months we do see those month-over-month inflation prints start to come down. The year-over-year numbers maybe start to improve. I mean, maybe it's wishful thinking at this point, but that's what the Fed is hoping for. So we could end up with kind of peak Fed hawkishness and peak inflation that kind of coincides with the uncertainty around the midterm elections. So maybe we do end up having kind of a more complete market washout, sort of leading up to the midterms. But again, I wouldn't extrapolate that because that's happened because of the midterms, but it could just sort of play out this way.
We've heard the drumbeat around recession grow louder and louder. The Fed ex-CEO saying we're either in one or heading into a global recession. The World Bank saying that now is going to happen. Preston, you wrote a couple months ago, didn't feel like it yet. We hadn't seen all those indicators yet. We're not there. We don't know until we're already through it. How likely is a recession from your point of view? And if so, how deep, how long, and how severe?
Yeah, and first, just to wind back to the last question, I am, like Dave, reticent to speak about near-term market movements. But one thing to watch is that Fed sales from their long-term asset balance sheet have yet to peak. They've set out a framework where they're going to sell up to $95 billion a month of Treasury and mortgage-backed securities. And as of the latest weekly data, they're far below that maximal monthly rate. So we've got potentially a long ways to go before that headwind to asset markets really plays out fully in the near term. But in a longer term framework, I think the Fed will calibrate those asset sales to keep markets and yields from rising too much and reacting too adversely. But to answer your question about the recession situation, yeah, we're not in a recession yet by my assessment. I mean, we had a first quarter and second quarter GDP drop, real GDP drop in the U.S., but that was driven by the noisiest components of GDP, inventories and net exports. Most other economic indicators like employment, real consumption, industrial production all rose in the first half of the year and have continued to at least inch up in the last couple months going into the third quarter. And there's no real reason to expect a recession to have arrived already. I mean, there is the inflationary headwind, but the impact of the Fed tightening is really only just now starting to filter through into the economy. And the way that happens, the biggest channel is by cooling off the housing market, and then you that impact starts to filter through to the rest of the economy. So the timing doesn't really make sense to have peak recessionary risk right now. So recessionary risk will peak in 2023, and in my GDP forecast, I'm expecting 1.6% real GDP growth this year, and then troughing at 1% next year. So that will put us, close to that recessionary threshold, and we might, string together another quarter or two of negative real GDP growth if you shock that forecast downward. But crucially, though, after 2023, because I think that the Fed is going to start cutting rates, I expect growth to reaccelerate with the resolution of these supply side issues, giving the Fed the ability to restart the demand side of the economy and get the growth rate back up to 3% in 2024 and even a little bit above 3% in 25 and 26.
Yeah, given those growth rates or those slowing growth rates, how does that usually impact the equity markets when it's all about future, discounting mechanism for the future? When we think about earnings growth and we think about all the things that go into what investors project into stock performance over time, what would that mean?
Well, I think we've already been living through it, the first half of this year, seeing as much as we have. And we think the market has really been overcorrecting to the downside at this point, again, from kind of that intrinsic long-term valuation perspective. So when you think about like what Preston's talking about, yes, we do expect to still see the economy, being a relatively low rate. Was it 1.2% that you're forecasting for next year?
Yeah, 1% next year.
1% next year. So again, we already are taking this into consideration in the equity markets today. But then when you think about, the value of these companies and looking for the economy then to rebound, in 2024 and 2025, I think that's part of the reason why I think we have kind of a differentiated view on the market today and why we think the market is undervalued as much as it is.
Yeah. We were talking earlier, Anastasia, about the dollar. The dollar is so strong right now against pretty much every major currency that it trades against. When you look at the basket, there's not a lot that governments can do about that. Sometimes we want a strong dollar, but in this case, a strong dollar is kind of where a lot of the money is flown to, and it's also hurting companies that do a lot of exporting to the U.S., but also companies that half the companies in the U.S. and the S&P 500, they're big exporters to other countries. How big is that going to be in terms of an issue weighing on overall market sentiment and direction going forward?
Yeah, I think there's a couple of impacts. I mean, the first one is, you said it exactly, it's the sentiment channel, right? And that's clearly weighted on equities. And you can kind of see it on the days where US dollar kind of reverses and declines. You can see equities breathe a little bit better. So I think there's the sentiment channel, but then there's also the actual foreign sales and the translation impacts. And if I'm not mistaken, and maybe David, you can correct me, but it's not an egregious amount of downside to earnings. Maybe it's like 1 to 3%. Maybe it's a little bit more, and certainly more for certain companies. But it's not. I think that for maybe David, the numbers, but for like a 10% move in the dollar, maybe it's like 1 or 2% hit to the S&P 500 earnings or something like that. And I mean, we've clearly had that already.
Well, actually, on top of that, not only is it really not that large of an impact, and there will definitely be companies in Q3 and Q4 that miss earnings because they didn't hedge their FX. But I think when you think about FX, unless you're going to think that the dollar is going to continue to keep strengthening at the same rate we've already had, it's really just more of like a one-time hit to earnings. And when I talk to our equity analysts, they're really looking at the organic growth of these companies. What is this company doing? What are the underlying fundamentals, X, the foreign exchange differential, to really understand, what are the fundamentals and what the value of that company is.
Yeah, great point.
Yeah, it's a great point about, how much further does the dollar strength have to run? And look, the ECB, the risk bank, and everybody else in the world is playing catch up. We saw the 100 basis point hike from risk bank this morning, and the ECB is just getting started. I think there's plenty of potential for ECB to surprise markets, with hawkish moves, whether it's on the asset purchases program, whether it's repricing the expectations. So as that occurs, and at the same time as the Fed probably gets to 4.5% as hopefully pauses, maybe they cut, maybe they don't. But I think as that interest rate differential starts to narrow, the pace of further appreciation of the dollar should not be supported, and we would at least expect the dollar to peak or maybe give it back some of its strength.
Yeah, I concur. I think we're seeing largely a one-time adjustment, especially for developed economies, where we were in a situation previously where markets thought inflation was going to run quite a bit higher in the U.S., and now, at least in the European economies, inflation is going to be much higher there next year. And so, if you think about just a basic model of FX rates, you tend to think about nominal FX rates moving in the opposite direction as inflation differentials, so that the two offset each other, and the real exchange rate is unchanged. And so, in that scenario, actually, not only is it kind of a one-time shift, but then you would think that nominal earnings in European economies would be elevated in euro terms because of the higher inflation there, and that kind of offsets the FX headwind.
Yeah, but that's not happening because of a lot of other things that are going on right now for investors, David. Typically higher rates, typically good for financials, except when people are fearing there's going to be this long downturn right now. But as investors are looking around at this landscape, inflation potentially coming down, maybe aggressively next year, rates rising, we know, until we get to 4% or somewhere near there. Where do you recommend people look right now as we reset? We're going back to the conversation we were having in the first panel, but right now, as you look at that landscape, what looks like the place that the sectors that might do well?
So broadly speaking, in a market that we think is about 17 to 18% undervalued right now, the greatest valuation we see is actually in the communications sector. So that's trading at over a 30% discount to our fair values. Now, in that sector, I do have to note that over half of it is weighted just towards Alphabet and to Meta, two companies that we think are very undervalued today. So that is going to skew that broad sector. But I would say even the traditional media companies and traditional communication companies, generally we think that there's a lot of value for investors there today. Now within the cyclical sleeve, we see a lot of value, especially in the consumer cyclical industry, specifically those companies that are geared towards services. So one thing that Preston had highlighted a while ago in some of his writing is that during the pandemic, we did see a huge shift in consumer spending behavior, away from services and into goods. And as the pandemic is receding, we expect that to normalize. So we do see a big shift of people going back to services. And so there's a lot of companies there that we see are very undervalued, based on that, catalyst today. The basic material sector is another one that I think investors should be taking a look at today, kind of following on, some of the renewable energy and clean energy programs out there. Most of the lithium producers we think are significantly undervalued today. Based on the analysis our equity team has done there, they think that lithium is going to be undersupplied by over 1 million tons per year by 2030. And so that'll keep the marginal prices high within that sector for the next decade.
Yeah, we kind of need that component for cars
Exactly.
and phones and just about everything else we use these days.
Yeah.
Anastasia, as you look at the markets and sectors that may be becoming more attractive at a time like now, and as you look down the next 3 to 6 months, what looks interesting to you?
So Caleb, you talked about this, and I'm going to pick up on it, is the apartment REITs, or the multifamily residential real estate. I mean, one of the things that is clearly happening, if you look at the mortgage payment relative to income, it has risen astronomically since the beginning of the year, and you compare that to the rent to income ratio, which is so far has actually stayed in check, even though rents are rising. So as you pointed out, and I completely agree, is we are going to see, we're seeing now, the would-be home buyers that are turning to the rental market. Well, guess what? The multifamily residential vacancy rate is maybe 3%, maybe 4%, but is historically low. And it's not, you can't print the 3D apartments, at least we don't have the technology at scale today. So even if the supply rises a little bit over the next 18 months, which we expect to, I think a lot of that supply is likely to be absorbed. So the bottom line is here you have a space with incredibly strong fundamentals. There was just a real estate conference Bank of America hosted last week, and 100% of their REIT companies that were there said they are seeing very, very strong demand, and they're not seeing any sort of slowdown. So the demand for multifamily residential housing is absolutely there. The supply is constrained. So all else equal, you would expect the market rent growth to continue. And so you have a sector here that allows you the opportunity for the inflation pass-throughs. It gives you a yield in the case of publicly traded apartment REITs of north of 3%. One of my big themes in this market is you got to get something that has at least a fighting chance to compete with cash. And so dividend yield, distribution yield is very important. So apartment REITs definitely have that. And again, strong fundamentals, inflation pass-throughs, and that's a sector that's corrected significantly in terms of valuation, probably more so than any other sector as rates back up. But if Preston is right, and I hope you are, and the Fed is sort of going to peak at 4.5, and maybe they cut next year, I think you can see another really powerful tailwind to the valuation of some of these REITs. Even if we are headed into a recession scenario, the last thing you probably still pay is your rent. So I would expect collections to stay pretty high.
Yep.
So
Yeah, and if I may, just piggybacking off the idea of a recessionary scenario. So one point I forgot to make earlier when we were talking about a recession is we tend to think about this as a binary thing. Is there a recession or is there not? But that really doesn't tell you all that much about the economy because recessions historically come in many different sizes, shapes, flavors. Our memories as investors and workers, consumers are scarred by what happened after the Great Recession, where it was a very sharp, painful, and long-lasting and impact recession. But many post-World War II U.S. recessions, and just recessions in any country in general, are not like that. They're much shorter. And I think that if we do go into a recession next year, it's going to be relatively mild. Even if it is somewhat sharp in impact, somewhat worse in impact, it will be short-lived because it really will be designed to bring the rate of inflation down. And whenever that happens, the Fed can tap off the brakes again and let the economy get roaring again.
Yeah, I mean, is there a moral hazard there now by policymakers, whether it's on the fiscal side or the monetary side, where they're just not going to let that happen? They're looking at the stock market very closely, even though they're not supposed to look at the stock market. They're looking at the people's ire over inflation or over economic conditions. Is it always going to be the government to the rescue, do you think, going forward, or do you think that economic cycles will kind of return to a normal state? And I don't even know if there is one.
Sure. I mean, as long as they're not in a stagflationary dilemma where, let's say inflation is still 4% or higher, then yeah, they have the green light to support GDP growth. And that's not, the government acting in an inappropriate way by any means. That's textbook fiscal and monetary policy. And really it should be monetary policy is all that's required to make that course correction.
You make it sound so easy.
I mean, we've dealt with a lot of unprecedented volatility over the last year, and it's made our policymakers seem a lot dumber, in hindsight than we would hope that they would be. But given the circumstances they were facing, we might grant a little bit of leniency there. And once these issues, which are still lingering from the pandemic, resolve, we will be in a much more normal environment and one much more conducive, I think, to good monetary policy making.
Yeah, I'll ask you all of this question, and then we'll open it up real quick to questions from the outside. But what's a wild card that you don't think enough people are talking about, Preston, or something that's out there that you just don't think is getting enough attention that could be a factor in terms of market direction going forward?
Yeah, well, I think it's getting enough attention now, but what's going on with the slowdown economically in China is a major factor, and I've had some experience covering the Chinese economy. I don't think we're going to see a full-blown financial crisis just because of the strength of the government grip on the economy in that country, and they have very strong capital controls that prevent capital from fleeing the country and creating a full-blown panic there. So I don't think it's going to be a crisis, but it's going to be really a decade-long slowdown and pivot in how that economy is geared. And it could be worse than I expect, and that would be something to watch out for.
And that was not the plan for this government in China. They were hoping for many, many years of intense growth. Dave, wild cards, things people aren't talking about that you think need more attention?
Following exactly up on the discussion of China, I think with the strengthening of the U.S. dollar, I think it's up 15% across the board according to the dollar index. Trying to understand how that may impact some of the emerging markets. Again, could this be another repeat of a emerging market crisis? So I don't think that we are looking at that as our base case at this point. But if we do see continual strengthening of the dollar, yeah, that certainly could be something that could really weigh on market sentiment and have a lot of different impacts in the future.
Yeah, great point. World Bank was just writing about that this week. Last word from you.
I guess I'll stay with the China theme too. It's a wild card. It's not the base case, but we had these discussions about China and Taiwan kind of simmering in the background, and nobody's base case is really that there's going to be any sort of military action. Not my base case, but if you think about what China is trying to accomplish, they're trying to be the leader in 5G, robotics, artificial intelligence, electric vehicles. What do all of those things have in common? They require a whole lot of semiconductor content. And guess who has something like 80% of the production capacity of semiconductors in the world? It's Taiwan. I'm not saying it's the base case, but for now, the policy, I think, is kind of a quiet coercion. But to the wild card could be if that quiet coercion changes into something else. So I think it's a risk that after what we've seen this year with Russia and Ukraine, I think that geopolitical risk is something that we always have to keep in the back of our minds.
Yeah, tough talk by President Biden on 60 Minutes this weekend about that. So
Tough
something
talk.
to definitely keep in mind. We're going to take any questions that came in online and any from y'all if you have some in the crowd. But let's start with what you got, Jeff.
Okay, we have one. If government policies affect stock market performance, then historically speaking, what policies lead to higher market performance?
I think we don't think government policies necessarily impact stock market performance, except taxes.
Yeah. And that could be, a potential. So again, if the Democrats were to retain control of both, we could see maybe if they're looking for additional spending programs, maybe they bring back, increasing the corporate tax rate. So again, that could be, maybe another wild card that they increase the corporate tax rate back to where it was, depending on the company, depending on what they can do in order to manage their tax rates, that could be anywhere from like a 4 to 8% hit, in valuations of companies. So that would probably be the one that, I'd be most concerned about.
Yeah, taxes, usually the one that has the biggest impact from the government, from the fiscal side of things. Any other answers on that?
Just really quick on that. So clearly taxes, because we've seen the big stock market repricing in 2017 when the tax cut got passed. Well, some of those provisions actually sunset or expire in 2025. So it's possible the 2024 election cycle is going to be about taxes once again.
That would be interesting. Now, Back to the Future. Anything on that, Preston?
Yeah, I would just, as far as the tax question, I would just distinguish, taxes that are levied on capital from, income taxes. I think asset prices from a fundamental standpoint should respond to, the corporate tax or the capital gains tax, any tax that's levied on capital. But from a macro standpoint, just changing the tax rate incrementally is not an earth-shattering event that should affect asset valuations.
Yep. Keep an eye on the Fed, I would tell that questioner.